Hello, and welcome to the Baird Trust Equity Income First Quarter Portfolio Recap. My name is John Watkins, and I'm a co-portfolio manager on the strategy. Jumping right into performance, the table at the top of this slide shows our performance track record. In the quarter, our portfolio declined 5.5% gross of fees and 5.8% net of all fees, compared to the 0.7% decline in the Russell 1000 value. And for the trailing one-year period, we were up 11.2% gross and 9.8% net, compared to the Russell 1000 value's 11.7% gain and the S&P 500's 15.7% gain. So after a very strong year in 2021, where our portfolio was up over 27%, outpacing the Russell 1000 value's 25% gain, the script was flipped this quarter and we underperformed our benchmark. This is a great example of how unpredictable short-term performance can be and why we don't place any focus on our short-term numbers. This includes both when they are good, like last year, and when they are not as good, like today. On the bottom half of this slide, we've listed the top and bottom contributors for both Q1 and the one-year period. If you look at the bottom contributors for the quarter on the right-hand side, it is clear that Home Depot was one of the biggest drivers of our underperformance, detracting over 2 percentage points from our return this quarter, with the stock down 27%. Over the short term, Home Depot's stock sometimes trades up or down based on the housing cycle, and today's higher interest rates are causing fear that Home Depot's business will slow in the coming months. But the company's long-term success won't be driven by the ups and downs of the housing cycle, but on its ability to continue to delight its customers, gain market share through multiple cycles, and grow its cash flow per share. In addition to the individual stock price performance of the companies listed here, there was another factor that was a substantial driver of our underperformance in the quarter. We have no holdings in the energy sector, which was by far the best performing sector in the Russell 1000 value, rising nearly 40% in the quarter. This detracted over 2 percentage points from our relative performance. Our view is that energy companies have cash flows that are volatile and are entirely dependent on the price of a commodity that is impossible to predict accurately, which is why we do not own any in the portfolio. Over the short term, stock prices can move around based on many factors unrelated to the underlying business fundamentals and are often driven by investor emotions. But over long time periods, 5, 10, 20 years, a company's stock price will more accurately reflect the success or the failure of its underlying business. This is where our focus remains. At the end of the day, we're trying to grow your wealth at an attractive rate over many years while also generating meaningful and growing dividend income. Over the nearly 10-year history of this portfolio, there have been short-term periods where our investment performance lagged the benchmark, but we feel strongly that our strategy is fully intact. Moving on, this slide shows our recent portfolio changes. We made no changes to the portfolio in the quarter, which is not unusual for us. Most money managers move money around, shifting their portfolios based on the news of the day to try to capture short-term trends. We are seeing a lot of this today. Our strategy is different in that we try to own businesses with consistent and growing cash flows over a period of many years, often for a decade or longer. Because of this, our trading activity is often infrequent, which results in an extremely tax-efficient portfolio. On the left-hand side of this slide is the list of the 11 portfolio holdings that increased their dividend payments in Q1. I would note that 6 of these increases were in the double digits, highlighted by the incredible 49% increase in UPS's dividend. And then the table on the right shows the dividend characteristics of our equity income portfolio compared to our benchmark, the Russell 1000 value, as well as the S&P 500. As a reminder, 2 of our 3 portfolio objectives are to achieve a higher dividend yield and faster dividend growth than both of these indices. As you can see in this table, as of March 31st, we are achieving these objectives. Our portfolio has a current yield as well as a dividend growth track record that is superior to that of both indices. Unlike many dividend managers, we believe dividend growth is critical to our long-term success, especially in today's world of elevated inflation. A stream of income that is growing rapidly is much more valuable than one that is growing slowly or staying flat, even if the latter provides more current income today. Finally, just a few big picture comments. The first quarter of 2022 saw a dramatic change in the equity markets. The optimism of 2021 was swiftly replaced by pessimism, which resulted in a much more volatile stock market in the quarter. While there are many underlying factors, we think that the key drivers of today's uncertainty are twofold. First is the Federal Reserve's policy shift to tackle elevated inflation. This is going to lead to higher interest rates and the removal of liquidity from the markets. Second, Russia's invasion of Ukraine introduced a level of geopolitical uncertainty in the world that we haven't seen in quite some time. So we don't know precisely how the shifting Fed policy or the geopolitical upheaval will impact the economy or the stock market. Fortunately, our strategy and our long-term investment success is not dependent on our ability to make these sorts of predictions. In fact, there are likely to be more surprises ahead that we aren't even contemplating today. We believe that the future is always uncertain, although there are times like today where we're reminded of this fact more often. We built this belief into our investment process, which is designed to be prepared for both the tough times and the good times before they arrive. We do this by focusing on only owning high-quality businesses that have competitive advantages, great leaders, attractive dividend characteristics, and that trade at compelling prices. We will stick to this time-tested process for many years to come. That does it for the Q1 portfolio recap. We look forward to reporting our Q2 results to you in July. Thanks so much for your time.